Assets as we know them can be categorized as financial and non-financial assets. It is important to understand the different types of instruments and their role in your net worth to better understand the impact of your financial decisions. On the one side, we have non-financial assets such as real estate, be it in terms of built-up properties or land. Precious metals like gold, silver, or even vehicles and equipment are also examples of non-financial assets. Within financial assets, we have assets producing fixed income and those giving variable income. Examples of fixed income assets include instruments that we are most familiar with, such as bank deposits, bonds, small scale savings, provident fund, and liquid funds. Variable income assets that most of us are aware of include equities and mutual funds. Included within this class of variable income assets are equity, equity-linked savings scheme of mutual funds, exchange-traded funds, and hybrid mutual funds. A typical Indian household has almost 77% of their wealth in real estate. Another 11% is invested in gold. Only a small amount of 5% of the wealth is distributed into financial assets. This 5% is inclusive of savings accounts, deposits, retirement accounts, stocks, and mutual funds. Just for our reference, US households invest around 44% in real estate, while in Germany it is only around 37%. If the attention paid to your wealth is spread based on the current value of your net worth, variable income assets will constitute only a minute portion of your time. Just because these instruments are highly liquid and you can get their change in value at the tip of your fingertips, it does not mean you must focus most of your time on this. Within the course of this video series, we will attempt to list and explain the common mistakes made by investors in the stock market. We shall go over most common mistakes that we have seen personally, along with the impact of their influence on one's investments. It is very important to note that in overall wealth creation, variable income assets usually constitute a very small portion, but small variations in those prices induce high levels of panic. The equity indices have never destroyed overall wealth of any individual in the long term. If one has the flexibility of a couple of years, equity instruments have always performed better than fixed income assets. Process-driven instruments always fare better in the longer run. Passively managing investments only makes sense for fixed income assets as their trajectory cannot be changed. Passive management of variable income assets is best achieved through exchange-traded funds. These ETFs mimic the index in that they are managed by a set of rules and processes. Now, let us look at the average returns earned in bank deposits, gold, and Sensex during the period 2001 to 2020. Returns earned are captured for periods of 8 years investment, 9 years, 10 years, 11 years, and 12 years. Let us see how they have performed in the last 20 years. Bank deposits have given a return of 8.45% per year if you have invested for about 8 years period of time. The same way, if you 9, 10, 11 and 12 years, there is not much of a difference. Only 8.45 to 8.46% is earned. But we must remember, interest on bank deposits is subject to tax at a marginal rate of taxation. So if you are in a high income tax bracket, this will be subjected to highest income tax rate in your assessment. Let us now focus our attention on gold. Gold has generated a return of 12.89% compounded annual growth rate on an average if you have held the gold for 8 years time period. If you have held the gold for 9 years period, it gave 12.87. If you have held it for 10 years, 12.75. For 11 years, it was 12.56. And for 12 years, it is 12.45%. Compared to bank deposits, gold, if held for long term, is subjected to long-term capital gains. So there will be a considerable concession in income tax treatment as far as gold is concerned. Now, let us focus our attention on how the index or Sensex, BSE and Sensex has generated returns in this period. If you can look at it, it has generated a return of 15.21% on an average if you held on the investment for 8 years period. If you held on it for 9 years, it has generated 15.35, and for 10 years it is 15.45, and for 11 years it is 15.59%, and for 12 years it is 15.61%. Mind you, all these are compounded annual growth rates, which implies on an average, if you hold the Sensex for a longer period of 8 years, it is subjected to a tax of long-term capital gains at only 10%. which implies there is a considerable tax treatment and there is also higher returns earned by the Sensex, which makes it more attractive. Interest rates on fixed deposits do not undergo a change frequently. In that sense, people investing in bank fixed deposits can anticipate their income flows with certainty. When it comes to investing in gold, though the short term price changes during the day or from day to day, the price changes do happen, in the longer term, the volatility of the short term is evened out and the returns earned by the gold investment are higher than even the bank returns. And now, coming to the equities, where the prices keep changing during the day and also from day to day and from year to year, the Sensex may go up and down. But when you take in return over a period of 8 years to 9 years, 10 years, 11 and 12 years time, as we have seen, the returns are far more than bank deposits and also more than gold. And apart from that, investments in equity are subjected to favorable tax treatment of only 10% on long-term capital gains. In order to ensure that investors who want to capitalize on the long-term benefits of equity investments, index investments also is made possible now with exchange traded funds, which is nothing but they exactly mimic the behavior of the indices in the market. I hope from this video you can take away that each investment instrument has its own way of growth, like we have seen in bank deposits, gold, and equities. Volatility in returns is a risk in the short term but an opportunity in the long term, as we have seen it in the case of gold and equities. Process driven approach like exchange traded funds always outperforms people driven approach. I hope to see you on our next video as we go through number 1 of the common mistakes.